My fellow investors, pack your bags, it's time to go shopping. We have a market pullback. I hope you're taking advantage of it. Make sure to buy the dip. I wanted to talk about the top things, most common things I hear that people say about the Roundhill Weeklies that they get wrong. The first one, and this one is so silly, they say, well, they're expensive. The share price of these ETFs does not matter. It doesn't matter. When you look at the yield, which a lot of them, the ironic thing is they like to, always point out the yield. Well, the share price is included in that. The yield is a ratio of the share price to the distribution. That's why it changes all the time, because the share price is always changing. It doesn't matter. It doesn't change the mechanics of the fund. It doesn't change the yield. Now, if it goes down, yeah, the yield can go up, or if the price goes up, your yield on cost can increase, but the price doesn't matter. The only way it would matter is if you can't scrape together, $40, $50 to buy into it, and that's if your broker doesn't allow partial shares. So it doesn't matter. They don't earn premium. Okay, while although true, I would argue it doesn't really matter when it comes to total returns or the distributions. It doesn't matter with either one of them. And it's an incomplete sentence. What they should be saying is they don't earn premium, but they don't have capped upside. They tend to leave that off. And when you look at, total returns, the ones that have been floating up in price, they've done really well and they've outperformed, which is exactly what you would expect with them. The whole thing that premium, it doesn't earn premium. Well, if you look at these options funds, the majority of them, the premium isn't making up for the capped capital gains. So it really doesn't matter. What matters is total returns. And when you look at total returns, they're doing very well. So I don't think it's honest to be saying that. I really don't. I need 6 months of data. I need to see how it performs for 6 months or longer before I buy in. Well, if you look at HOOW, for example, in a few months, the first few months of the ETF, it's ran up. It's over $70 in price. It's up 32.8%. If you wait for a lot of these opportunities, you miss out. You could have bought it, when the share price was lower, and then you could have had, these capital gains. You could have had these extra earnings. You could have had some really good distributions, and now you're going to have to buy in, because you waited, you're going to have to buy in when the share price is higher. I won't invest in leverage products. Although that's fine, and that's your personal decision, I just think it's funny that these same people invest in MSTR. You can't make this stuff up, guys. It will, or it can, go to zero. Well, I would say most assets can go to zero. I would say Bitcoin is probably not going to go to zero. The broad index funds are not going to go to zero. But I would say, most individual assets, yeah, they have a chance of going to zero. And these are no different. So, if there was a case where you have a plummeting NAV, how would Roundhill kind of manage that? And if you look back at one of their ETFs, WEED, and you can imagine what that one is based off of, right? They did a reverse split, and it was actually a 5-for-1 reverse split, to protect investors' principal. And now I would say, although that is not really what you want to see, I would never want to see a reverse split. I would rather, especially in an income ETF, see a reverse split than my principal go to zero. Now, I haven't seen an official statement on this from Roundhill, whether that's in fact what they would do, But we could look at their other ETFs, and they've done reverse splits to protect investors and their initial principal. A lot of people would say, well, you don't want to see reverse splits. You also hear some people say, I tend to agree with them, it's really not that big of a deal when it comes to like options funds or income ETFs. It's not the same as, a company stock. If you see company stock do a reverse split, that is a huge red flag. With these, it's not really the same. So that's pretty much it. I think that's those are some really common arguments I hear against them. I don't think any of them have any weight. I don't think that there's any weight to any of those arguments. What do you all think? Remember to like, subscribe, do all the things, and I will see you in the next video. Stay tuned.